Perfect. Well, good afternoon, everyone, and welcome to today's webinar by the Payments Association and Autorec. The webinar is on the practicalities of safeguarding, where misunderstandings come from, and how to prepare for the worst case scenario. Before we get started, I have a few quick bits on housekeeping. You can submit questions to today's speakers by typing your questions into the Q&A tab of the control panel. There is also a chat box for discussions, but please use the Q&A tab as they will help the speakers keep track of what's coming in and you're more likely to get answered. You can send in your questions at any time and the panel will address some as they come through and some towards the end. We do want your input into shaping the conversation and we'll be making plenty of time to answer questions, so please don't be shy. You can ask questions anonymously if you prefer, but you can also write your name as well. If you have any technical difficulties, feel free to use the chat function and message me directly, Christina Gatens, from the Payments Association on the chat box. I would now like to introduce you to Melissa Corkhill, Head of Risk and Compliance at Modular and a member of the Payments Association's cross-border working group. And on to today's webinar. Welcome, Melissa.
Thank you so much. Just slight correction, it's actually the Payments Association Project Regulator that I am a participant in, but very pleased to be here. Before we get started, I'd like to introduce a little bit of context about the subject, and then we'll move to introduce each of our panelists. Knowing that customer funds are properly safeguarded is a critical concern, not just for the customers themselves, but also the FCA and the over 1,300 firms that are authorised as payment and e-money institutions in the UK. In 2021, the Payment and E-Money Institution Insolvency Rules came into effect to enable speedier and more efficient return of customers' money in the event of an insolvency. Also in that year, the requirement for firms to have an annual independent external safeguarding audit was introduced. In January this year, the Treasury in its payment services regulations call for evidence, talked about changes to inform the regulation to make it better future-proofed and agile, including new rules around safeguarding of customer funds. The FCA raised its concerns about safeguarding in their CEO letter in March this year, highlighting that many firms do not have sufficiently robust controls and therefore present an unacceptable risk of harm to their customers. So it's a critical topic, and with the expectation that the FCA will be publishing a consultation on new safeguarding rules, this I think is a very timely opportunity to hear from our panelists. So if I could start with introductions of our panelists, could I start with you, Natalie? Would you like to explain your role and your particular interest in this topic?
Thank you very much. My name is Natalie Zorzella. I'm the manager of the FCA Payments Policy Team. So my team are leading on those new rule changes to replace in the long term the the framework that's currently in the PSRs. So safeguarding has occupied a great deal of my time over the past 12 months or so, and I'm obviously keen to share with you our thoughts, our concerns, what's driving our work, and also to hear from you about your experiences of the current safeguarding regime.
Thanks, Natalie. We're very pleased to have you join us. And could I move to Nick now?
Hi, yep, sorry, just struggling to come off camera there. Yes, hi everybody, the name is Nick Buerta. I'm the Global Payments Manager here at Autorec, proud sponsors for today's webinar. Autorec is an end-to-end financial data control platform that works via the automation of data management, reconciliation and reporting processes. I think my particular interest here lies in that I've been working with a lot of members of the Payments Association, but also members not part of the Payments Association within the EMI space over the past four or 5 years. And safeguarding has been a particular interest for our clients. And with that being said, it's become a particular interest for Autorec too, with us deploying a safeguarding module to really help facilitate some of the processes around the operational side of safeguarding. So I'm looking forward to today's session. Thanks, Melissa.
Thanks, Nick. Thank you. Alison, would you like to go next?
Thanks, Melissa. Hello, everybody. It's a pleasure to be here. I'm Alison Donnelly, a Director of FSCom and a Payments Regulation Specialist. At FSCom, we've been supporting firms over the last 10 years since I've been here, working on how to understand the safeguarding requirements and how to be compliant. And a lot of our knowledge comes from the how industry practice has played out, but also because I was the e-money policy specialist at the FCA prior to joining FSCom. And my big surprise when I came around to the other side of the desk was to realize how firms were misunderstanding the obligations and the expectations. And so I've been working on this for quite a few years. I'm very pleased to see that in the recent years, there's been a real uptick in understanding of the requirements. The practical implementation is a little bit different and difficult still. And I look forward to that discussion today.
That's great. Thank you so much, Alison. And I'm hoping that people can hear me a little bit better now. James, would you like to go next? Introduce yourself, your role and your particular interest. Have we lost James?
I can see James, but I can't hear him. James, very odd as we could hear you before.
Okay, shall we just move then to Paul while we sort James's mic out?
Yes.
Hi there, my name is Paul Whelan. I'm Chief Compliance Officer of P-Free Money or Privet Free Money Limited. We're an EMI specialising in high net worth individuals and their companies. Obviously, I'm at the sharp end of safeguarding in that how to make sure we are compliant.
Thanks, Paul. James, would you like to have another go?
No, unfortunately,
No.
I can't hear you. If you'd like to try rejoining the webinar, alternatively, if you'd like to join by phone as another option.
Okay. While we're waiting for James to join, I'm hoping that my audio is better. There were some messages saying that it wasn't too loud, but I will continue. So let's start then by thinking about the current approach to safeguarding. How is it working in practice? And I wonder, Alison, if you could start by kicking us off, because you'll have exposure to a number of different examples of how it's practically working or not in your role.
Thank you. Yeah, like from my perspective, from the way I see it, the main difficulty with the safeguarding provisions in the statutory regulations is that it is statutory regulations. The information, the detail in the rules is actually quite limited. There's not very much by way of rules in the payment services regulations or the e-money regulations. But because it's statutory rules, it bumps up against the insolvency legislation. And the only way we really know how it's going to work in practice is through seeing it being tried in practice, which means, of course, that there's firm failures, and seeing how judges in the cases of court cases apply the rules and apply the legislation. And for many years, there just haven't been court cases, which, that's good. Firms haven't gone bust. Customers haven't lost money. Great. But there have been more cases, a few cases, smattering of cases recently. And that gives us the opportunity to see how the legislation works in practice, which means that we see that on balance, judges have actually taken a very pro-customer position, and their aim is to get as much money back to the customers as possible. Now, thing is, none of those have actually gone to the highest court in the land, so we still don't have absolute certainty on how to interpret the rules that we have in the legislation. And secondly, what we see is that it can actually be quite expensive to have to go through your court process, because of course the fees for returning the money back to customers, and whether or not it goes through court or not, the fees for returning the money back to customers gets taken from the pot of funds for the customers. So you're never going to get 100% back in most cases if there's administrators involved. And this situation, this leads to the FCA having to take a very precise, now some might say pedantic, but a very precise approach to how safeguarding is carried out. Everything has to be to the exact penny. We often say to clients, look, over safeguarding, i.e. putting too much money in the safeguarding account, is actually as bad as not having as much money in the safeguarding account, because the concern is that if you've got too much money in there, the administrator or the court might decide that money belongs to others other than customers, and the protections of safeguarding is broken. And so it has to be very down to the very precise penny. And that's difficult in payment services sector, because the nature of most payment service business is that it's money that comes in and goes out pretty quickly. You can follow the process if it's one set of money coming in, going out, you can see where that goes. But when it's multiple money coming in throughout the day, money going out throughout the day, it begins to get very complex, particularly if there's FX, so there's different currencies. It's 24/7 in many cases. And so the complexity just simply builds. And so we have a situation where firms find it very difficult to shape their business model to the exact and very exacting nature of the requirements. I'm going to pause there and let anybody else answer.
I was going to say that's really helpful, and you've covered quite a lot of different angles there, so I can see how they link together. I'd be interested, Natalie, in your perspective from the regulator's point of view. Are the things that Alison's saying resonating?
Absolutely. I mean, taking a step back, when we look at the safeguarding regime, our principal concern is that customers should get as much of their money back as possible in all circumstances, including that worst case scenario where a firm has failed. And at the moment, our experience of the regime is just that consumers do not get all of those funds back for all of the reasons that Alison has referred to. Over the last couple of years, 7 of the 12 payments and e-money firms that have failed have had shortfalls of over 50% in terms of the customer funds that are available for distribution. And the other problem that we see is that it's taking a long time to reach distribution. So customers are out of their money for a long time. Of the 6 cases where funds have now been distributed to customers, it's taken over 2 years on average for a first distribution to be made. And many of you will know that it's taken several high-profile applications to reach the current legal understanding of the regime. But there does remain, as Alison said, ambiguity in the regime even after these cases around things like what other assets can be used to top up, or the effect of third-party rights in those assets. And our experience is that insolvency practitioners, in seeking the certainty that they need in order to enable a client distribution, are seeking court directions as to the treatment of funds, which increases costs, as Alison mentioned, that come out of the funds, and the time required to return those funds to customers. And for us, there are kind of 2 drivers. One is the lack of certainty in the regime itself, which Alison has referred to in terms of the very high level that it's set at, and the potential for different interpretations of that. And the second is that firms, in terms of their practices, either don't have enough detail in their safeguarding practices, don't really understand how that regime applies to their particular business model, haven't worked through that to make sure that what they're doing on the ground matches up to both their business model and the legal requirements. So when you see an insolvency practitioner come in and find something that is incongruous between how the firm has been going about record keeping and what the legislation requires, they then seek that certainty from the court to enable distribution. So I think it's sort of it's a combination of those two things, trying to get at that certainty that's needed in the legal regime, and get at kind of firms really reaching that level of compliance with the with the regime that will enable smoother distribution of those funds.
Thanks, Natalie. And I think that's great timing to hopefully bring James back. James, we weren't able to introduce you fully earlier, so perhaps you could. Still not able to hear you. No. Okay. We'll have to try and come back to you, James. Apologies, everyone. Technical issues, clearly.
Melissa, sorry to interrupt. Just so you know, James is going to join by phone as a worst case scenario.
Okay, that would be good, because I'm really hoping that we can have an input from someone who's experienced the sharp end of insolvency practitioning. Great. So Natalie, I think you've explained with Alice and also some of the challenges that we have currently. What would you say as the overriding problem that needs to be resolved, that can't be achieved with the rules as they are currently?
Thanks. I think it really comes down to that level of legal certainty. So what we can do over and above the regime as it's laid out in the payment services regulations is issue guidance on what we understand the effects of the regime to be. Now, that guidance obviously reflects our best understanding of how we think the regime should function, what it requires. But when it comes to those sort of lines around where the edges are of the regime, which funds are and aren't in that special bucket of needing to be returned to customers, our guidance can't impact that. We can't change that. Where there are, for example, really awkward bits of sort of, this bit is relevant funds if this happens, but this bit isn't, we can't tinker with those edges because that is set out in statute. So our ambition with our new rule set is that what we can do is have the regime be in one place and be able to address those areas of uncertainty or those awkward areas around the edges to help make it a little bit easier to comply with the regime, make it a little bit clearer what's in and what's out, and that in turn feeding into the legal certainty that's required in a resolution context.
Okay, so what sort of time frame are we talking about for the introduction of these new rules?
So we are aiming to consult early next year on these new rules covering safeguarding. We had intended to consult before the end of this calendar year, but we have experienced some slippage. You will all be familiar with the level of congestion in the payments regulatory landscape at the moment and competing HMT legislative priorities. Plus, we're really, really keen to make sure that we get this right. So we're taking the opportunity of that little bit of extra time to carry on having engagement with industry and carry on refining our proposals ahead of consultation.
And are there any elements of where you're heading that you're in a position that you can share with us? I think there's been a lot of speculation that we'll be moving to a very similar regime to CAS, client asset money.
I mean, I think I can safely confirm that is the general direction of travel, is looking at something a bit more detailed and rules based, like the CAS approach. The CAS approach is not that different to what payment services firms experience now. If you look at the guidance that we have issued on what good safeguarding practice under the current regime looks like, a lot of that is heavily drawn from our experience and our learning on CAS. So many of those concepts are already very much familiar to firms. So a lot of what we're doing is moving that guidance into a rule book rather than continuing to have it as guidance. A key feature is going to be implementing a statutory trust, because we're going to lose that statutory insolvency insolvency protection that exists under the current PSR. So we need to have a way that we can replace that insolvency protection under our own rules, and a bit more prescription, as I've mentioned, around those edges of where the safeguarding obligation bites, when it starts and ends.
Okay, that's great. I'd like to bring Nick into this. I was wondering, Nick, with the rules as they are, do you have any reflections on practical issues for your firm or other firms that you're aware of in implementing the existing rules?
Yes, absolutely. I just want to probably bring in what Natalie just referred to there in terms of, going down the road of CAS, where, the rule books are, quite prescriptive. I think that's one of the main things when it comes to the clients speaking with us. They're asking us for advice on best practice because it might not have been as clear up to date. So when it comes to, performing the operational tasks around reconciliation and what do the reports need to include and look like, which funds are deemed to be relevant and non-relevant. Yes, I know everyone has to submit their proposal forward in terms of their safeguarding procedures, but whether or not it's correct is not clearly defined. So I think something like this may have a positive effect in terms of clarifying a lot of these things. We also work with clients in the CAS space. Many of our clients work in the CAS space, and then if we compare their level of understanding and requirements around the rules that CAS have versus what's the clients have within safeguarding, that ambiguity is quite challenging. And it also, it actually trickles down even further in terms of, how do the operations and finance teams need to actually be performing their tasks on a daily basis? Is this a BAU thing? Is this a T+1 thing? Everyone is a little bit concerned about their behavior towards safeguarding, and I think what Natalie mentioned there is probably the natural progression as what we've seen in the CAS space, but just how that's implemented is going to be hugely interesting to the behavior of e-money firms going forward. So yeah, interesting times, I would say.
Thanks, Nick. And Paul, are there any particular comments that you'd like to make on that?
There's a couple of things, like I agree with what Alison said earlier about the precise nature of safeguarding reconciliation and over and under being a problem. But one of the aspects of it being over that's a problem is it brings doubt to the method used for calculating safeguarded funds, and that's where the doubt comes from. And the key on a number of things here is having your policy and procedure in place and robust and tested and regularly reviewed. Now, I'm not going to say it's not a pain doing safeguarding reconciliation. It is, particularly if you're using a manual system, Excel, whatever. But having the form, having your process set out, who's responsible, who's the second person who's going to take over if someone's on holiday or sick, who's going to sign off on it, who's supervising it, who's reviewing it. They're all the key things that make it work and why you stay on top of it. Now, something that's slightly askew to this is, of course, we have the new financial resilience rep next year, Rep 73, which is going to, in theory, wrap into making sure that the companies are financially stable. So therefore, that the temptation for co-mingling or relying on safeguarding funds to keep firms afloat won't be there. And this is going to be, and someone's already asked a question about, the safeguarding orders. We've just done one. The safeguarding orders, are they being enforced? And the answer is, yes, they are being enforced. The FCA will on occasion ask for what audits you have done. And my advice to every company is now you should be planning your safeguarding audit for this year to be done early in next year. So you have it out of the way, boxed off and done, and have your audit subcommittee reviewing the responses of that audit so that you have appropriate remediations to get into best of class. And that's what every regulated firm should be aiming for. And when changes come, you're better provisioned. So you have good, strong audit firms that will operate in this sphere. And I know two of them are on the call at the moment, so I'm not going to favor one over the other. But like I say, get your audit firm in now, automate your reconciliation as far as possible, It's easier in some firms than others because of different currencies, different safeguarding providers, multiplicity. Keep an open line of communication with the FCA, particularly your case officer, so that changes in your safeguarding providers are well telegraphed and not just in your reports. And stay on top of it, and make it part of the board agenda for every board meeting. And assuming at least monthly board meeting, that there is a segment on safeguarding that's discussed by the board and that it's ratified by the board, so that people take responsibility for it, but it's also, culture in the business of having to do this. That it's bred into the culture of how we do this. How have we done the safeguarding reconciliations today? Who's doing it? What system are we taking the reports from? Have we tested this system? Is there a better way to do it? And that's why you would talk to companies like AutoRec as a good provider of making that an easier process for yourself. So consistency, regularity, and correction. That's the key to safeguarding.
That's great, Paul. Thank you so much. Now, I don't wonder if I'm playing Jeopardy here, but I'm going to see if it's possible to bring James in. James, are you able to join?
Let's see. Can you hear me now?
Excellent.
Oh.
Please briefly introduce yourself and your role and your interest in this area, and if maybe from what you've been able to hear so far, you can give your little bit of your perspective.
Yeah, apologies everyone, and good afternoon. So my name is James Cameron. I'm a director and insolvency practitioner at PwC, and focus on the financial services and regulated firms area. I guess what I was kind of hoping to bring today is around the discussion of the implications of not safeguarding properly and what the impact that can have on customers in an insolvency, but also then in terms of what can be done to mitigate that harm to consumers. I think overall, I won't repeat what's already been said, but wholeheartedly agree with what Natalie was saying around the safeguarding and the difficulties which we see when unfortunately firms do fail. I would just like to draw out a couple of additional points though, not necessarily around the segregation of funds, which is both internally and externally with third parties, which makes it difficult on an insolvency, but also in terms of ensuring that there's adequate data records for customers and the funds which are held, and the completion and the standards of the reconciliations being completed. All of that alongside the safeguarding directly has the ability to impact the ability to kind of have that timely return of funds, and therefore poor safeguarding impacts that whole process, because you've got the impact of the IPs having to go in and undertake far more detailed investigations, the likelihood then of going down the court application routes and the implementation of bar dates to enable customers to submit their claims against the relevant funds. And all of that impacts the timing, but also the costs, as Natalie said, around the cost of the insolvency process, which ultimately are borne by the customers with the lack of the FSCS protection in place.
Thank you. Thank you. We do have a few questions coming in on the Q&A. I would like to move to a couple of those, but at first I believe, Natalie, you might want to follow up on some of the points that have just been made.
Yeah, I wanted to pick up two things that Paul talked about. The first one is the importance of policies and procedures. Those policies and procedures are really how you get from the general and abstract nature of the regulatory regime to something that works in practice. And 100%, that's so important. One of the questions that we've seen pop up is there a sort of boilerplate safeguarding policy that could be shared that would sort of help firms to understand what's expected here? And the danger of that is that it does become, oh, we can just lift this if we write this down, copy paste this, even if we follow this, it's going to come to the right answers. And that's very much not the case, because there is a big diversity of business models here. So those policies and procedures are really important. you've got to work through them for yourself and for your own business, because no amount of prescription in the regulation is going to tell you how to conduct your own reconciliation. You need to work through how money flows through your business, where the edges are in terms of how you receive money, how you deal with mixed remittances, for example, or how you deal with international currency payments. You need to work through that in terms of how your business works and what that means for your reconciliations. So I think we're trying to give the regulatory support to guide you to that, but ultimately it is something that has to be done case by case. And the second point, which both Paul and James touched on, is the importance of record keeping, because especially in that worst case scenario where the firm has gone insolvent, your insolvency practitioner is walking into that firm with no knowledge of the business model of the firm, no knowledge of the history of the firm, and what they really need is that combination of really good records to show it the flow of the transactions, and those really good policies that speak to the business model of the firm, because those are the things that are going to enable them to pick that up, sort out whose money is whose, and get it back to customers.
Yes, great. And thank you for picking up on that question that someone asked about a baseline safeguarding policy. There was another specific question, I think, Alison, you may wish to answer. We are an API, and do we have the requirement of a daily reconciliation reports?
So you need to work this through on the basis of what your risks are. And sorry, actually, do you know where I'm going to start? I'm going to start with the point that some people think that reconciliation is the way to segregate your funds. No, segregation has to happen. You just plain old, and it's not even that you can start segregation at the end of the business day following the day of the receipt. You need to start segregation on receipt. So you get money in, you need to be able to segregate it. You take out the stuff that doesn't belong to the customer and you put the segregated funds into an account, especially for the customer. And then eventually they can go into the special safeguarding account. Now, once we've got that clear, then you look at reconciliation, because how do you know that you've got the right money in the right place? So reconciliation should be confirming that you have segregated. And I think you can then say, well, we can do that on a risk basis. If we have a beautiful system, and there are some firms that have a beautiful system where there's no FX and there's no fees, and the money just goes in and sits, and it's all very calm and collected. And when they reconcile, they very rarely see anything wrong. Well, then that perhaps then there's scope to not do reconciliation every day, perhaps, if that's the risk appetite of your business. But if you're having to do things like doing FX conversion, perhaps not safeguarding in the same currency as the funds are received in, or if there's any other possibility that the funds might get mixed up, then you need to reconcile more often, and distinguishing that from the segregation point.
Thank you, Alison. And we have another reasonably specific question that Paul, maybe you can help with. Can a startup EMI conduct a manual reconciliation at the start of its operations?
Yes, it can, is the short answer. The more complicated answer is very similar to what Alison has just said. It has to be consistent with your risk profile, what kind of complexity is in your business. If you're having multi-currencies, multiple banks providing safeguarding, multiple payment channels, then obviously, a manual system is going to creak. Now, manual systems can still do it, but you need to have the dedicated resource. So the dedicated resource is either an automated system or labor-intensive manual system. So where I agree with Alison is if you have one payment rail and it's money into a Cat 7 account, it's all good. It goes in, it's already there, you take your fees out, everyone's happy. But if you have multiple payment rails, multiple currencies, and multiple safeguarding providers like we do, you have to be on top of that on a daily basis, and sometimes even more than daily, because you have to make sure when you're sending funds, sweeping funds from one place to another, that they're arriving in the required time and that they're there. So you're checking and checking and checking again. So to me, it's not about the manual or automated. Automated is less labor intense and less, shall we say, mind-numbing for the individuals doing the work. But manual can do it, but you have to put the dedicated resource in and the dedicated monitoring in that resource is doing the job it's meant to be doing. And that's the long and short of it. Yes, but you have to have the resource.
Great, thanks, Paul. And we have another question that I think is more directed at Natalie. How are you feeling that the current provisions regarding safeguarding risk management are sufficient? And the person raising the questions indicates, in particular with regard to liquidity risk, FX risk, etc.
So what I would say is that a lot of that risk management is implicit in the current regime, i.e. if you don't have good practices in terms of that risk management, you will not end up compliant with the current regime in terms of what's set out in the PSRs. Our guidance kind of tries to draw out some of those connections, but I would say that it's an area where it can be challenging for us to really guide firms and for firms to understand what it is and how closely they need to manage those risks. As I say, our supervisors are very mindful of that. Our guidance seeks to draw it out, but the current legislative regime just doesn't specifically touch on those risks, which clearly are risks that, if they materialize, will put the firm in breach of its requirements under the PSRs. So it's sort of the current regime achieves it indirectly, which is if you don't do this stuff right, you will end up in breach of the PSRs because you'll experience volatility and end up undersegregated. You will experience a liquidity crunch, and you may not be able to meet customer demands for access to their funds, or be able to meet the D+1 payment obligations. But all of that is kind of in the background. It is sensible and obvious good practice in order to ensure compliance with the current regime. It's not drawn out explicitly in terms of the explicit requirements. And I think that is an area where the current regime falls short of what we see in other areas such as CAS, where those risks are explicitly called out and specific requirements on firms to have policies on how they manage those risks are included.
So does that mean that we can anticipate that being brought out as something in the consultation?
I'm going to say that you're probably going to have to wait to see the consultation to see exactly what our proposals are on that. I would say that sort of we're thinking very, very carefully about what is needed in terms of that liquidity and FX risk management. Yeah.
Mm-hmm. Okay. We're having a lot of questions come in, so I will try and get through as many as we can. One interesting one is another perspective, the perspective of the credit institution holding the funds for EMIs or PIs. The comment that there seems to be a lack of available information to provide guidance. It would be useful to get guidance on where the boundaries of the credit institution's responsibilities lie and the step-by-step requirements in the event of an EMI's failure. For example, if there is news or suspicion of an EMI going insolvent, is there a credit institution responsibility ahead of an insolvency practitioner being engaged? Alison, you're looking like you're keen to comment on that one.
I'll certainly comment, and I have a feeling other panelists may well want to get involved as well. So the first thing to point out is that there are two key areas where the FCA has signalled messages to the credit institutions, and there's, you know, as anybody involved in payment e-money institutions know, there's only a small number of credit institutions that are willing to provide safeguarding accounts. But the two key messages came, first of all, in the the voluntary reimbursement that Barclays made to the Premier FX customers. And the second thing is in the consumer duty guidance, there's a little sentence in there about firms understanding their risk and the material influence they may have on the end customers. And it specifically calls out credit institutions that offer safeguarding accounts. So I think that we can assume from this that the FCA does feel that there is a bit of follow-through obligation and understanding. And so in the example that's given in the question, I think it may well be hard for a credit institution to say that they saw signs and made no effort to do something about that. So I think the firms will need to understand where the risks are. Now relationship managers at banks are very, very knowledgeable about their customer base. They're there's often very deep relationships. They've really focused on AML to date, and they are now having to get familiar with the safeguarding obligations. The credit institution may not be able to see the fullness of the e-money or payment institutions safeguarding obligations. They may not be able to see all the safeguarding accounts because there could be money held elsewhere. But I think that with the information that they are presented, that they see, they need to have intelligent questions to get a sense of how well the payment or e-money institution understands their obligations and what they are doing to manage the risk.
And does anybody else want to come in on that point?
I think worth echoing. I mean, we are intensely conscious of some of the challenges that e-money and payments institutions do face in getting safeguarding accounts. So there is a very fine line to tread here. We do view credit institutions that operate safeguarding accounts as having a degree of responsibility if there are obvious signs that financial crime is being perpetuated through a safeguarding account, and such that sort of it's clearly the activity on the safeguarding account is clearly inconsistent with what they've been told that it is a safeguarding account. So for example, kind of staff salaries being paid out of the safeguarding account. I mean, that's an obvious no-no. There is no possible way that that is compatible with it being a safeguarding account, and that's a red flag that we would expect a credit institution to potentially be able to spot if it is providing safeguarding accounts services. But we do want to be extremely wary of a credit institution substituting its own judgment on when on the basis of incomplete information on when an e-money firm should be ceasing trade, should be ceasing to conduct transactions on behalf of its customers. And this links very much into kind of wind down planning. It's a key sort of the best way to ensure good outcomes for consumers in a worst case scenario is to avoid firms entering wind down in a disorderly way. And so that wind down planning obligation on e-money firms and payment institutions is really important in terms of planning. It's not just good for consumer outcomes, and obviously in terms of kind of the regulator being aware of when a firm has triggered sort of wind down planning, but also for the firm's own directors and its customers in terms of kind of making sure that their responsibilities are clearly discharged in that potentially kind of challenging worst case scenario. So very, very keen to emphasize that what we don't want to see is credit institutions substituting their judgment for the judgment of other regulated firms that have their own responsibilities and obligations based on their knowledge of their own business about when is the right time to cease trade.
And picking up on your comment about wind down plans, I wonder, James, from your perspective, what does a good wind down plan look like in practice for an insolvency practitioner picking that up?
Yeah, I was just about to jump in, Alyssa, as well, because it's worth saying having a wind down plan in place is brilliant. It's better than nothing. So it's always something to take away. But generally speaking, what we have tended to encounter is a wind down plan which is a bit lacking in detail. It's not necessarily fit for purpose as such, and the practical elements in terms of them being able to use it in either a wind down process on a solvent basis, or even in the case of where an insolvency has unfortunately happened, but as an IP going in, having that document to kind of help guide a bit of the strategy and the operational matters. So things like consideration and details of what third parties have been used, what systems are in place, agents, custodians, bank accounts, and for whom. Details on vulnerable customers is always massively important to enable us to tweak a strategy to help some of those vulnerable customers where it is appropriate to do so. Key employees and back office functions, details around those so that we can deliver an efficient wind down rather than going in. I saw reference to expensive insolvency practitioners. That's unfortunately kind of the nature of the beast when everything goes wrong. But by being able to retain a structure of the core firm in certain situations, that ultimately leads to a much better outcome. And then just one thing I would like to say is some of the nuances around the operational matters. So one of the situations we were involved with on a contingency planning was around the ability to keep the lights on for certain accounts up to a certain level of which the IPs could be comfortable at releasing funds. That was all good and well from the relevant funds being in place, we were comfortable, but ultimately, operationally, that wouldn't have been able to be delivered because of the systems processes. We would have had to have gone through some steps to get there. And all of those considerations can really help deliver a much more efficient wind down. Having an IP look over a wind down plan can be really beneficial, just to provide a bit of a different perspective and a different lens over it.
Great. Anybody else on the panel wishing to add some comments?
Yeah,
Paul?
just on the whole concept of credit institutions safeguarding providers, and back to the policy again, but there should be a process built into your policy and your procedure where you're assessing your provider on an annual basis at least, and recording why you've chosen a particular provider. And your due diligence on your providers is key as well. While they'll do due diligence on us as a firm, we are mandated to do due diligence on our safeguarding provider to ensure that they are up to scratch as well. So they'll do policy checks and us procedure checks, what our accounts are like. And someone made a question about insurance versus credit institution. Your way of safeguarding, you have to record in your policy as well, and how you've arrived at that reasoning. And I can see, again, referring back to the Reps 73 that's coming in, I can see credit institutions asking for copies of that every time it's submitted so that they can take an assessment on where things are going. And obviously, the wider audit requirement, financial audit requirement on firms is going to be a key test. And I've seen in the recent past, a number of EMIs have not done their audits. Financial audits, but that's key as well to ensure the financial viability, and therefore giving safeguarding providers that heads up about any potential problems. That the full audits have to be done. No one can take the small firm exception. So they need to do that's why it's key to have an audit subcommittee within the firm to actually set out what you're doing in terms of your safeguarding audit, your fin crime audit, your financial audit, working on your updating of your business-wide risk assessment and what's driving that.
Yeah, absolutely. Absolutely. And I guess on a sort of related note, thinking about safeguarding audits, one of the questions that I have is, obviously this requirement came in, and I'd be interested to understand, maybe from you, Natalie, how effective this requirement for an annual external safeguarding audit has been from the FCA's perspective, and if we might anticipate any changes in that area.
So what I would say is that safeguarding audits can be an incredibly valuable tool for a firm that wants to do the right thing to develop and improve its systems. So we have seen firms that have made a really positive response to those safeguarding audits, have been considering them, have been implementing the learnings from them, have been continually improving their systems and controls in response to those. There are other firms that view it as audit done, tick, file it, do nothing further with it. And that's not, in the FCA's view, acceptable behaviour, because obviously the purpose of that audit is to ensure that the firm is made aware where its systems and controls, its processes are leaving it short of the regulatory expectations. And that is an area that we are considering in next year's rules, in terms of both the scope of the audit requirement, who can conduct audits, and whether those audits need to be more consistently or more widely submitted to the FCA, so that the FCA can follow up on whether those follow-up actions can be taken. I'm not able to kind of give final policy positions on those, but those are areas that we are looking at as part of our ongoing consideration of the overall safeguarding regime, how we can leverage those audits to drive better results. Because, as you said, there are over 1,300 firms. We do not have enough supervisors to individually audit every firm. which is where the audit requirement can be really, really valuable as a tool for identifying those firms where there are problems and where we need to focus our attention.
And the audits have been invaluable for this, Natalie. I'm sure everybody agrees. I mean, as I said, I've been with FSCom for 10 years, so supporting the sector. Over those years, we did a handful of safeguarding audits up until 2020. Now, since then we've done more than 100. That's firms really having to get to grips with what's expected of them. It's going before their board, and they are beginning. And the first year is awful. The second year is pretty bad, but the third year, yes, they are getting there. This is, the FCA is not, it's not like in 2020 they suddenly woke up to safeguarding. They have been consistently over the years talking, and there's been so many iterations of this, of the approach document chapter. That's got to be the most expanded out chapter in the approach document, but it really, the audit is the thing that has driven it right the way up to the top, to boards really getting to understand, getting to grips with what the requirements are and the difficulties they face.
Sorry, if I could just, sorry, Melissa, if I could just jump in there.
We just have to be a little bit quick with this.
Sure.
Towards the end now, Nick.
Yeah, sure, no problem. So I just want to tie in what Alison mentioned there, in terms of, there's been quite a lot of questions in the chat box around the BAU, how this works in practice. And, when we've got people like Paul who have, advised the listeners today on, off the back of a safeguarding order, I believe, so there are learnings that have been taken from this, but perhaps, I could just add a quick 1 minute on what our clients are saying around some of the difficulties or some of the feedback that they've been getting from their audits around, not having particular procedures in place, especially around your controls processes. And I'm going to focus a little bit on reconciliation here, because there also have been a few mentions around, and I think Alison mentioned right at the beginning, around calculation to the exact penny. So, and then there was another question in the chat around, should we be doing this every day? And I think our opinion really comes back to what is the best practice approach to these types of things. And yes, maybe the regulators might be saying, that you have the obligation to be reporting on these reconciliations on a T+1 basis or on a daily basis. But in reality, if we're looking at liquidity risk, if we're touching on a little bit about what Paul said about using spreadsheets and what Alison spoke about calculation to the exact penny, to be able to achieve this all effectively, doing this more real time is in fact the best practice approach. The nature of payments is moving towards real time. So, I think that's maybe where the listeners' head should be going. How do we do this more real time?
Okay, well, thanks, Nick. And I think on that note, because of time, I'm going to need to hand over back to Kate or Christina. But I'd like to thank all our panelists for their insight and their interest. I think we could have kept going for another hour or more. Clearly, there's a lot to talk about on this topic. It's so very important, and we tried our best to answer as many of the questions that came in the Q&A as we could. And I believe that they'll be circulated to the panelists to see if there are others that we can follow up on outside this call.
Yes, indeed. Thank you to all of you, all of our speakers, for a really thoughtful and thought-provoking session. Thank you to everyone for joining and attending today's webinar. If you do have any questions, please reach out to events@thepaymentsassociation.org, and you will shortly be receiving a survey with the webinar link as well within the next 24 to 48 hours, so you can enjoy it on demand. And behalf on everyone at the Payments Association and our speakers, thank you for joining us today, and we hope you have a wonderful rest of your day. Thank you.